Hi everyone, it's Friday, November 8th. The market just closed a few minutes ago and we want to give you a quick update. Quite a week, quite a month, it's quite a past few months. So this week we enter the final phase of 2024 and head into 2025. And as we move to the next phase, the reason we're doing it is we now have several major overhangs that we've been dealing with in the market for the better part of the last 4 or 5 months. We've talked a lot about them, but first off, we'll rip through them because they're all now behind us. Number one, we've been waiting for the Federal Reserve to move out of a tightening posture and into a easing cycle. They have now done that, doing their second rate cut in the past 2 months yesterday. Number two, we have now moved through this seasonally weak period, historically, August, September, October, and now we're into the most strong period historically in the market, which is November, December, January. And then most importantly, the election that's been hanging up the market with 2 very different candidates, 2 very different policies and how they would affect investments. The election is now behind us. And as you know, we actually thought early on that Harris would win in our last video because usually historically the incumbent wins if, unemployment is low, the stock market's in good shape. But we did think, because that plan was to raise taxes, we did think the market would get hurt initially after that election. The fact that Trump won, now we're not going to raise taxes, we're going to lower them. And the market really didn't see this blowout victory happening. So we've gotten this euphoric rip up for several reasons. So now we're going to move into the final 2 months of 2024, and we're going to start pricing in earnings expectations for 2025 into the market. And there are several favorable tailwinds now, and we've been very bullish on this year. And I want to go back to some videos we did last fall, November of 2023, September, October, November, where the market really was going through a steep correction, and we kept putting buy signals on our short-term model on the chart that we keep on our website. You find the S&P running charts on our website. We also tweet these on our Twitter page. We post them on Instagram, so it's out there if you want to see it. But last fall, even though the market was in a pretty good correction and we were consistently buying at certain low points, we did say we thought the investment environment was incredibly favorable, and we were pretty positive despite that correction. And 2024 has been a historic year. I think we hit our 50th all-time high this week of the year. So out of roughly 280 trading days, we're hitting new all-time highs all the time. So anyway, now there are several favorable tailwinds. Number one, all these overhangs we just talked about, worrying about the better part of the last 6 months, they're all now behind us. There really are no overhangs in the imminent future. Number two, we have a dovish Fed, so they're cutting rates, so money is now cheap. Capital is cheap, both for business and personal people. So dovish Fed. Number three is we have strong seasonals, right? We're now in the strongest part of the year. We wait all year for this. It usually starts, I always view it as November 5th. And that is because we pretty much have a lot of tax selling that happens in October is now done, and people are beginning to reinvest back into the market November, December. But you also have 2024 is now kind of in the books for investing, right? Investments are forward looking. So the market and analysts begin to price in what they see happening throughout 2025 in earnings, and we begin to bake those into stock prices today. So no more overhangs, dovish Fed, strong seasonals, and then you've got the presidential administration that has been elected, is pro-business and pro-growth, and that's quite bullish as you're seeing this week in the market. They're going to be back to favoring M&A, where the Biden administration was restrictive on mergers and acquisitions. You're going to have lower tax rates, which is a direct hit to the bottom line. They lower corporate tax rates. That is a direct hit. The money flows through, rather than going to the IRS and the Treasury, it goes right to the bottom line of shareholders, and profits jump up. We saw this when they did the Trump tax cuts, back when the market went through a euphoric phase of pricing in that next section of earnings. And then thirdly, less regulation, which basically takes handcuffs off corporate America to go do various things that they would have been restricted under the present administration. So this is not just positive for what you see in technology, right? The mega trend is this huge build out of artificial intelligence. First, it's the tech companies that develop it, then it's the software companies that deliver it. But eventually it's going to go to every single company in the world as they begin to find ways to run more efficiently, run more profitably, and grow faster. So, but it's not only beneficial for technology, it's really beneficial, this administration, for finance companies, banks, and Wall Street. Stocks like Goldman Sachs, Morgan Stanley. because there's going to be a ton of deals that have been very pent up. So, and in fact, we kind of swapped out of our Bank of America position into Goldman Sachs. We just thought it was a stronger investment bank, and the profits of investment banking will hit the bottom line rather than a big commercial bank. We sold our Bank of America shares. We went into Goldman Sachs. Goldman Sachs in 2024 is up about 51% year to date. That is pretty much tied with the Mag 7 stocks, up 54%. And it really had a good rip this week as the Trump administration won the election. So, yes, a positive for banks. Boy, we're positioned really well. Clients will know that. We keep hearing from them when they get their statements every month. This summer, we position names like the Russell 2000, IWM is the ticker symbol, the small cap index. The stock, we started positioning that in July, heavily overweighting it. It's one of our top, 5 or 6 positions right now. It's up 18.5% year to date, but it's up 17.5% in just the last 3 months, and it's up 8.5% this week. So, our timing on that in July was really, really favorable. We loaded up on Palantir. We've owned it for a couple of years, but we loaded up on it in the spring. That stock alone is up 100% in the past 3 months. It's up 35% in the last month. And now, kind of in the last few weeks, we've been positioning for stocks that we really like, heading into year-end, new names, or names that we were in lightly, and we're now building them up to top positions heading into 2025, we think are really exciting. So clients will begin to see those in their statements. What else can we talk about? So the only flies in the ointment, we're bullish, but the only flies are that it was a sweep, right? So the Republicans look like they're going to take the House. They took the Senate, or taking the Senate, and they took the presidency. So market likes gridlock. So really, it would have been okay for corporate America if Harris won, right, with higher corporate taxes, but Congress and the Senate would block any excessive moves in taxes. Well, we didn't get that split that the market seems to like. We got a sweep. So it's a double-edged sword. In the short term, it is incredibly bullish for investors. And with the Fed lowering rates, it's even more bullish. And let me explain how this sort of, but then 2 or 3, 4, 5 years out, it has some consequences. So let's talk about how this usually plays out. There's no guarantee it'll happen again, but this is the way I've seen it happen over the course of my career. With cheap money, Wall Street is going to do what it does best. With less regulation, the handcuffs are off Wall Street. They're going to look for some area to exploit. It was the housing market and collateralized mortgage bonds back before the financial crisis. It was IPOs of tech stocks that really never should have been brought public back in the 90s in the tech bubble, right? So they take away regulation, they make money cheap again, and Wall Street exploits some area. And at first, it's a really healthy product, and investors in those products do very, very well. And the Wall Street firms make tens of billions of dollars, right? So as the collateral, the sector begins to die off, they pick weaker and weaker collateral into these entities, these vehicles, and then they start to employ more and more leverage. So with no regulation, what ends up happening is, it's the Wild West out there, and some dangerous products get created, and the minute rates kind of tick up in this over-leveraged sector, overvalued sector with cheap collateral, crappy collateral getting into the backing these instruments, that's where you can get in trouble. And it has ramifications throughout the entire financial system. So, for the next couple of years, it should be green lights, it should be bullish. After this administration, you want to watch out and see where things get excessive. It is our job to be monitoring these things and knowing when to, rebalance out of risk and back into safer assets, waiting for the next big correction that we get, the next great buying opportunity, and we know it's going to come. Now, the only, flies in the ointment as we speak is that the market is very expensive right now. It's certainly not cheap, which could make 2025 kind of sideways and at times down. So you're right, we're at 21 to 22 times earnings, next year's earnings. So that's really pretty expensive for the market. Not saying it's not justified. It kind of is with the growth you're seeing in technology. But, don't be surprised to see the market go sideways to down it for periods of time to allow corporate earnings to catch up with the valuations we placed on stocks. So we would not be buying stocks right now. All that sweat equity was made last year in the fall, and all the pullbacks we bought on this year. I'd be sitting on my hands right now if I were an investor with cash. We dollar cost average a little bit of that money every month for new cash that comes in, but then we wait for pullbacks. And again, you just follow them on our chart. We tweet this stuff out. We tweeted a buy signal on the afternoon of November 5th, election day, before we knew the results, just because our model had gotten so oversold. And despite knowing that one of the candidates could go in that would probably be negative on the market, we still have to slap that buy signal in when we see it, right? And that just simply means that the market is oversold or overbought. Today, with the rally we saw this week, today the market is clearly overbought. So we didn't put a hold on yet. But we might. But at some point, I could see in the next 6 months de-risking a little bit, right? The pyramid grows bigger, taking the risky stuff off the top, putting it into the base of our portfolios. But for now, the market's path of least resistance is higher. As I've always said, the only thing that concerns us is a geopolitical event that you can't see. But I think even a lot of that is off the table with the Trump win, because a lot of these rogue nations that would press the administration, the United States, our allies, they're back on their heels a little bit, redigesting their stance and kind of recalculating future plans. So that's where we are. It was a hell of a week. It's been a hell of a 2024, and it's been a good market for us, where we spent most of the summer deploying assets that we're now seeing winning today, knowing we had to get through the major headwinds between August and Election Day, November 5th. So we will see where we go. We will monitor things going here. Please stay in touch with us. You'll be getting your statements soon. I think everyone should be pretty pleased. And we hope you reach out to us with any questions or comments. Have a great weekend, everyone.